Some people say that high-yield ETFs like ULTY or MSTY are basically money printers, a way to stretch every dollar further and lock in income far into the future. And honestly, at first glance, that idea can sound convincing. After all, we're talking about funds designed to pump out massive distributions month after month or even week after week. But here's the thing, those assumptions usually leave out a few critical details. There are other factors quietly working in the background that can make or break the long-term outcome for investors. Factors that can turn that money printer into something far less exciting if they're ignored. So in this video, we're going to put that claim to the test. I'll simulate exactly how these high-yield ETFs could work like a money printer under the right conditions. And then at the end, I'll share my take on whether it actually makes sense, plus the kind of market environment, fund structure, and investor behavior that would need to be in place for these ETFs to truly keep printing money. Let's walk through a real-world example using ULTY. Let's say you buy ULTY today at its current price of $6.12. Based on my calculations, since the fund's inception, ULTY has delivered an average 12-month yield of about 156%. Yeah, I know, that's not what it's paying right now, and payouts have definitely cooled off. But for the purpose of this simulation, we're sticking with the average to see how the math plays out. Now here's the catch. While that yield looks incredible on paper, ULTY's average price decline over 12 months is around 49%. So, let's put this into real numbers. If you put $10,000 into ULTY at today's price of $6.12, and it somehow kept paying its historical peak yield of about 156% per year, while also experiencing that same 49% annual price drop we've seen before, here's what happens. Month after month, you'd collect a steady stream of income, roughly 13% of your initial value every month. That stacks up quickly. By the end of month 10, you'd have pulled in over $10,000 in total payouts, more than your original investment, all while still holding shares. Sounds like the perfect scenario, right? But in reality, ULTY hasn't been paying anywhere near that sky-high yield recently. Its latest distribution rate is closer to 89% annually, which changes the math entirely. Now, let's run the same simulation using ULTY's current reality, about an 89% annual yield. We'll still assume the same 49% annual price drop, which is roughly what we've seen since the fund launched. You start with $10,000 at today's price of $6.12. That buys you about 1,634 shares. From there, the monthly payouts begin, around $741 in month 1, but those payouts gradually get smaller as the share price falls and your investment erodes. Here's the surprising part. Even with that erosion, by the end of 2 years, you've pulled in just over $10,056 in total income. That means you've technically made back your initial investment through distributions alone. But there's a trade-off. By this point, your original investment has shrunk to about $2,751. If we fast forward all the way to year 10, you would have collected another $3,575 in income, which works out to about a 35.76% total return over the final 8 years. That's roughly a 3.6% compound annual growth rate. And by the end of that decade, your original $10,000 is now worth $12.59. If you're satisfied with a 3.5 to 3.6% return annually, then that's perfectly fine. More power to you. But Jay often emphasizes
reinvesting those dividends.
So let's explore what happens if we take half of those payouts and reinvest them back into the fund. In month 1, you start with a distribution of $741.67. Half of that, about $370.83, goes straight into your pocket. The other half, $370.83, is reinvested to buy more shares. Since the price in month 2 drops to roughly $5.79, that reinvestment gets you around 64 extra shares. So even though the fund's price is eroding, you're growing your share count month after month. That means your monthly income falls at a slower pace compared to not reinvesting at all. The larger share base helps soften the blow from price declines. I know, your brain's probably screaming, that makes zero sense. But that's the beauty of it. The math doesn't care if it feels right. It just is. And when you run the numbers, this is where you end up. Without reinvestment, your principal would shrink much faster, your monthly income would collapse quicker, and your ending value would be far lower. Now here's the catch. Reinvesting means you're playing the long game. Instead of getting your $10,000 back in just over 2 years, you're waiting 37 months. That's an extra year of patience before you're made whole. But this is where it gets exciting. By the time you hit that 37-month mark, you're still holding about $5,299.50 in the fund. That's capital ready to keep working for you. And then, over the next 7 years, that capital pays you an extra $8,655 in income. That's an 86.56% total return in those 7 years, which works out to an 8.7% compound annual growth rate. And here's the part that really makes income investors smile. Even after all that time and all those payouts, you're still sitting on $1,225 in the fund. That's your little income engine, still running, still producing cash long after most people would have walked away. Now, I know by this point you might be thinking, this is amazing. How did I not see it before? I'm going to take all my money and dump it into MSTY and ULTY right now. Here's the problem, and why that could be a big mistake. Before you start treating this like a guaranteed outcome, we need to look at the fine print, or in this case, the massive assumptions baked into models like this. First, we're assuming the monthly yield and the monthly price decline stay exactly the same for a full 10 years. Reality check, they won't. Covered call ETFs yields swing based on volatility, option premiums, and overall market conditions. And price declines, they're not a neat, predictable line. Some months are flat, maybe even positive, and others feel like you've fallen off a cliff. Second, this model completely ignores market volatility. There's no simulation of sudden drops or bear market sell-offs. A rough market could slam the price much faster than we've modeled, which would make any reinvestment plan way less effective. Third, our reinvestment timing here is perfect. Every month we're buying at exactly the month-end price. Real life isn't that neat. Reinvestments happen on set dates, and prices could be higher or lower, which changes the math significantly. Fourth, we haven't even talked about taxes. If you hold this in a taxable account, distributions can trigger tax bills, which eat into your reinvestment power. And for foreign investors, withholding taxes can slice off part of the distribution before it even hits your account. Finally, we're being really optimistic about the recovery timeline. On paper, this model says you get your initial investment back in 37 months, just over 3 years. But that only works if yields stay high and price declines behave exactly as modeled. In the real world, both can change drastically. Look at ULTY as an example. At certain points, you could have modeled a totally different annual price decline, but the reality was it just kept dropping and dropping. Now, to be fair, the price has been relatively stable for the past 4 months, so we'll have to wait and see if that holds. Let's take a moment and dream for a second. What if ULTY didn't lose value? What if the share price stayed the same for 10 years? No volatility gut punches, just smooth sailing. The only adjustment we'd make is lowering the annual yield to 50%, which is roughly a 35% drop from the original rate. Here's what that fantasy looks like in the numbers. We start with $10,000 at today's price of $6.12, which gives us about 1,633 shares. In this dream scenario, the fund keeps paying a 50% annual yield. That's around 4.16% every month, which means you're collecting about $416.67 every single month, like clockwork. In just 24 months, that's 2 years, you've pulled your entire $10,000 investment back out. But here's the kicker. You keep getting that $416 every month for the next 8 years, and because the price never drops, your principal is still sitting there at the end. By the end of the 10 years, you've withdrawn $50,000 in total income. That's a 400% total return, with a compound annual growth rate of 40%. And your $10,000 is still intact in the fund, like it never went anywhere. This right here proves why price decline matters. I'm not saying the price has to be perfectly stable or always going up. A gradual decline of maybe 5% to 10% annually can still be sustainable. But when you start seeing extreme drops of 30% to 40% year after year, that's a whole different story. Over the long term, the rate at which a fund's price erodes is one of the biggest factors that determines how sustainable its income really is. Because no matter how high the yield looks today, if the price is falling off a cliff, that income won't last forever. At the end of the day, none of us can predict the future. These funds could stabilize and perform better over the next 5 to 10 years than they have in recent years. That's possible, but I'd be willing to bet that some of the more aggressive ones will keep seeing their prices fall quickly unless they make changes to slow the erosion. And in many cases, that might mean simply not paying out more in distributions than they're actually earning in premiums. In the end, it all comes down to why you're investing in these funds. If they fit your goals and they're working for you right now, then that's great. Just remember, sustainability is the real test. So, could these funds be a money printer? Well, no fund is a literal money printer. Markets are unpredictable, and factors like inflation, interest rate changes, or economic downturns can all impact the performance of these funds over different time periods. These are extremely high-risk instruments. If you know how to use them, they could work for you over the long term. But that takes skill, discipline, and a clear understanding of the risks involved. As always, none of this is financial advice. Do your own research, and if this video gave you any value, make sure to like, subscribe, and share it with someone who might find it helpful.